important aspect of that bills that affect us as individuals and then as entities. So I'll just try as much as possible to talk about few points that are critical. And I would also like to mention again that this is still a bill that is currently with the National Assembly for consideration. So it has not been passed. And of course, whatever we are discussing today is still a draft format, which can still change because National Assembly, in their own wisdom, may deem to change one or two things in the bill. So there may still be need, even after it's passed and signed by the president, there may still be need to still get ourselves refreshed to understand or know what exactly is the final position on the law. So I will be going straight into the presentation, and like she said, please feel free to drop your questions or notice somewhere. And because of time, maybe at the end of my presentation, we can then have time to take some questions. Right. So this morning, we'll quickly look at a brief introduction of the bill, and then we look at the general overview and talk about major highlights, and we look at taxation of individuals under the National Nigerian Tax Bill. And of course, we look at taxation of capital gains, taxation of companies, economic development tax incentives, value-added tax, and of course, penalties for non-compliance. So these are the areas that I will try to talk about in the next 1 hour. And to start with this bill, sorry, let me put, okay. This tax reform bill was actually commenced in 2023 after the inauguration of the present administration. A committee was inaugurated to oversee the reform of our tax administration and fiscal policy, with a clear mandate from the president to the committee to develop a policy that will guide the fiscal governance, revenue transformation, as well as economic growth and competitiveness of businesses in Nigeria. So that's the mandate given to this committee, and the committee has started work since 2023 when it was inaugurated. And as part of their work, which is to develop a policy, they came up with recommendations and policies that were presented to the National Executive Council. This was adopted some months back, and after their review and few amendments here and there, that was transmitted to the National Assembly via an executive bill. And the bill, like I mentioned, is currently with the National Assembly. The tax reform bills are made up of 4 different bills mainly. We have the Nigeria Revenue Service Bill, the Nigerian Tax Administration Bill, we have the Joint Revenue Board Bill, and of course, we have the Nigerian Tax Bill. Each of these bills focus on a particular aspect of our tax administration. You know, before now, we have various tax laws, and in each of these laws, you see the composition of board for each one, you see the functions, you see the fiscal framework and everything in the different laws. So what the committee has recommended is to have different law that will deal with different issues. When you are talking about the revenue authorities, there should be a law that will tell you, oh, this is the composition of the tax authority. You have we have at the federal level, you have at the state level, and what are their functions, obligations, and all that. And of course, we have the administration bill, which deals with the tax administration itself. How do you administer tax? How do you register people for tax? What and all that will be in another bill. And of course, you have the Joint Revenue Board, which will take over the functions of the joint task board that we always know, which is like a board that is coordinating the activities of the different various revenue services. And of course, there is the fourth bill, which then deals with the fiscal framework of taxation in Nigeria. So this are the composition of this tax reform bill. So when you hear about tax reform bills, there are actually four different bills that have been presented to National Assembly. Like I mentioned earlier, prior before this time, we have different laws. So part of what these bills will achieve is that it's going to streamline the the tax laws instead of having a different law for different issues that has to do with taxation. So everything is going to be streamlined under these four bills that we have. And when that is done, most of the existing tax laws will be repealed when this new law is passed. And prominent among those laws that will be repealed, we have the Capital Gains Tax, we have the Casino Act, Companies Income Tax Act, Deep Offshore, and the Inland Basin Act. We have the Income Tax Industrial Development Act that will also be repealed, and other laws, including the Personal Income Tax Act. And in fact, when you look at some of these laws, you agree with me that there are some of the laws that you won't be hearing that you don't even know they are in existence, right? And we have a law of 1939, which is the Stamp Duty Act. This law will also be repealed in the process of this tax reform. And there are other laws that will still be continue to operate, but of course, this will now focus on regulatory and administrative functions of these various agencies of government, and not regarding the tax or levies collection. We have some of them that will still continue to be enforced, like the custom and excise tariff, have the National Information Technology Lottery Act. And of course, recently you are aware that the Supreme Court nullified this National Lottery Act to say that federal government has no power to regulate that. So that, again, is something that will still be considered even in the process of passing the law regarding these tax bills. And Petroleum Industry Act will still continue to be in place, of course, like I mentioned, the administrative part of it. And the Tertiary Education Trust Fund will continue to operate, as well as the Significant Economic Presence Order. So all these ones will continue to operate, but there is going to be amendment as a result of the bill. So that is just the overview of the four bills. Like I mentioned, the Tax Administration, the Revenue Service, Nigeria Revenue Service Bill, and the Joint Revenue Board Bill, as well as the Tax Nigeria Tax Bill. So these four bills are what the National Assembly is currently reviewing now. So I will go straight to the tax bill, which deals with the fiscal framework, because that is what is going to be determining what tax we are supposed to pay on what revenue, right? Before now, we have a Personal Income Tax Act that deals with taxation of individual. We have Company Income Tax that deal with taxation of companies and all other acts. But now, the Nigerian Tax Bill, when passed to law, which will now become the Nigerian Tax Act, is going to deal with everything that has to do with taxation of both individuals and companies in Nigeria, and not just looking at different laws at every point in time. So under this new bill, the tax bill, we have currently part of the reasons for even starting this tax reform is again to address the issue of different taxes and levies that are collectible or collected at the various levels of government. And is in the course of the committee, the presidential committee on this fiscal reform, because of their work, they were able to come up with about 60 different or over 60 taxes and levies that are being collected at different levels of government. But now, these over 60 taxes and levies will be streamlined into a maximum of 9, right? So under the tax, the Nigerian tax bill, we have the income tax, which is going to cover company income tax, personal income tax, petroleum profit tax, and capital gains. And of course, we have a levy that has been introduced, which is called development levy. We have this value-added tax, stamp duty, and of course, excise tariff. So these are the major taxes that you are going to have going forward, which is covered under this national tax bill. So the major highlight that we have in this national Nigerian tax bill is one, the harmonization of the various tax laws. Like I mentioned, we are now going to have single tax law, so you don't need to be looking for personal income tax act or complex income tax act. So we have just single law that deals with the fiscal framework going forward. We then have separate legislation for administration and the fiscal legislation, and then changes in the structure of revenue collection agencies. We are going to have changes as a result of the Nigerian Revenue Service bill. And again, we have, as part of the proposal in that bill, is to make FIRS or the Nigerian Revenue Service and the State Internal Revenue Service to be responsible for collection of all taxes and levies that are due to government. Then all other agencies will then focus on regulatory activities, and not that today taxpayers are dealing with FIRS on one hand. Tomorrow, you see another agency of government coming for another oversight or tax from that taxpayer. So everything is going to be under one, under either a Nigerian Revenue Service and the State Internal Revenue Service. And of course, companies' income tax rate is going to reduce to 25% in the next 2 years. We also have the personal income tax rate, which is going to vary between 15% and 25%. We have something that has just been introduced now before issue of minimum tax, whether as a company, whether you make profit or not, you're expected to pay minimum tax. That has now been removed. A loss-making company will not be required to pay any tax going forward. And we also have the threshold for determining what is a small company. We have the threshold now moved from 25 million that we have in the current law. That is now increased to 50 million, or any company with asset base of less than 250 million will be classified as a small company. Next, we have gains from disposal of assets are now taxable as normal income. Right, so that is also a new introduction. We have VAT rates to increase in the next 4 or 5 years. The VAT rate is going to be increased to 15% from the current 7.5%. And we have another good news again, that the all companies are entitled to claim full input VAT on all their costs, which is different from what is currently in operation now. We now have expansion of items that are exempted from VAT. And Stamp Duty Act of 1939 that I mentioned earlier has now finally been repealed. So we have a more friendly Stamp Duty Act that can be easily understood by people. And we have the act or the bills also propose the establishment of what is known as Office of the Tax Ombud, which will act as a mediator between taxpayers and the tax administrators. What this office will be doing is to be, if a taxpayer is having issue regarding or dispute with tax administrator, before you take the step of even going to tribunal or going to court, you can engage the tax ombud to come on board to see how that dispute can be resolved. So those are the highlights of the bills, and we'll be looking at specific areas now that will affect us either as individual or as entities. So we'll be starting with taxation of individuals under the tax bill, the Nigerian tax bill. And to start with, before now, we used to have, or currently, not before, we still have that minimum tax for individuals in the existing Personal Income Tax Act, which applies on 1% of a gross income of an individual. So you look at your tax computed using the tax table and then compare that with 1% of gross, and the higher of the two will be paid. So that will no longer be there. It's either you are liable to pay tax or there is no tax. So there is nothing like a minimum tax for individuals again. And then individuals are also liable to all income or profit or gains that accrue to them in Nigeria, which is what we still have now. Again, everybody or all individuals earning income of 800,000 or 1 million, 1 million because of the additional rent relief of 200,000. Income of 1 million naira is exempted from tax for everybody. So if as an individual, the total income of the person is just 1 million naira in a year, such person will be totally exempted from payment of any tax. We have a new relief that has just been introduced, which is called the rent relief. And that provides for a maximum of 200,000 or 20% of rent paid by individual. Of course, a lot of people have been criticizing this particular relief that is too ridiculous, given a relief of 200,000. Somebody that paid, let's say, an annual rent of 2-3 million is only allowed to take deduction for 200,000 as a rent relief, which is far, far below what we currently have as consolidated relief allowance of 200,000 plus 20% of a gross income. So that is definitely going to affect or increase the taxable income of all individuals. We also have a new provision that has been proposed for benefit in kind, respect of accommodation. This is now restricted to 20% of gross income of an employee that receives benefit in kind, respect of a living accommodation from the employer. What we have currently is a situation where if employer pays rent on behalf of employee, the total rent paid will be taken as an additional income in the hands of the employee, right? But with this new proposal now, it's restricted to maximum of 20% of gross pay of that employee. So if the rent paid is more than 20%, only 20% will be considered as an additional income for the employee. And in terms of deductions, the existing deductions we still have, which has to do with pension, national housing for national insurance health insurance fund, interest on mortgage, and the life insurance, all that are still going to be retained in the new law that we are going to have. And when you then look at that, the tax table has changed drastically. That's the payee tax table. What we have currently is the first 300,000 of 7%, the next 300,000, and all that. And from 3.2 million currently, individuals are liable to tax at a rate of 24%, which effectively puts anybody earning income of above 3.2 million currently is effectively about 19.2%, right? But with this new rate, the band has now been increased and the rate has also been adjusted upward. So we have the first 800,000, which is totally exempted because it's zero rate. And we have the next 2.2 million taxable at 15%. The next 9 million taxable at 18%. And we try to do the computation to say, if you earn 2.2 million, for instance, the total tax that will be paid by such person is 330,000. When the income increase and up to like 12 million, the total income that such person, the total tax payable by such person will increase to 1,950 million. When the income increased to 25 million, that's the next 13 million there, which will be taxable at 21%. The total tax payable by such person will be 680 million per annum. If the individual or taxpayer is earning up to 50 million, and that's at the point where we have the next 25 million, if you add everything from beginning, it will give you 50 million at that point. So the next 25 million there, if somebody is earning up to 50 million, the person is going to pay tax of about 10.4 million per annum. And above that 50 million will now be subject to tax at a 25%. So this is what has been proposed to National Assembly. And when you compare this to what we have currently, you will see that at some point, there is going to be a shift in what we currently have as tax. So this is a comparison showing a particular level of income, what the tax is currently based on the existing Personal Income Tax Act, and of course, based on the proposed. When you look at somebody on 1.5 million naira annual income currently, the person is currently paying about 90, almost 100,000. The proposed bill, under the proposed bill, the person tax will reduce to 57,000. And when you look at the variance, you see that the person's ETR will drop from 4% to from 7% that we have currently to 4%. And at income level of 3 million, the tax will also drop. So the tax will drop up to everybody earning about 25 to 30 million. The tax is going to drop when you do the simulation, considering the new rate and of course the relief of 200,000 that have been given for rent relief. So everybody earning below 30 million, for instance, their tax is going to reduce with this new, with the proposed bill. And from 35 million and above, the tax will start increasing. So anybody on 35 million income per annum, for instance, is currently paying a tax of about almost 5.9 million. And under the new bill, the tax is going to increase to 6.3 million. And when you look at the ETR, you see that the ETR has increased from 17 to 18. and it will continue like that. For people on 60 million, the tax will also increase from an effective rate of 17% to 19%. And for the high income earners, you see their tax also drastically increase from 17% ETR to 21%. So, which seem to align with what the presidential committee has been saying, that the idea of amending the personal income tax rate is to ensure that the low income earners don't carry the tax burden, to make sure that the high earners pay more tax than the low income earners. And when you look at this table, that has clearly demonstrated that issue of the high earners paying more. So this is what the new tax is going to look like for individuals, right? Provided we don't have any change from the National Assembly, either to the band or to the rate itself. If we have any change in the band or the rate, that will alter this simulation. But based on the bill that is currently with National Assembly, this is what is going to look like. So let's look at capital gains. Currently, we have capital gains tax under the Capital Gains Tax Act. But with the new bill that has been proposed, capital gains on disposal of chargeable assets is going to be taken as part of normal income of whether individual or entity disposing chargeable assets. And what is the impact of this? For individuals currently, if you dispose an asset and you made capital gains, that capital gain will be liable to tax at rate of 10%. But with the new bill, the tax on the disposal can go as high as 25%, depending on the value. So that is one of the critical changes that has been introduced. And again, losses from disposal of assets will be allowed as a tax deductible expense. Currently, it's not allowed, right? But that is going to be allowed. And for individuals, there is a relief that has been granted to individual, that where an individual, for instance, disposes of his personal dwelling house, or decide to sell his vehicles, up to maximum of 2 vehicles, any gain derived from such disposal will not attract capital gains tax. And for shares also, there is also an exemption that has been provided for disposal of shares. Currently, we have exemption in the Capital Gains Tax Act, which provides for exemption of disposal of shares below 100 million naira is currently not liable to capital gains tax. Under the new bill, the threshold for exemption has been increased from 100 million to 150 million, which means if as an individual or entity you dispose shares and the value is below 150 million, there will be no capital gain tax on such disposal. However, where the gains on the disposal is above 10 million naira, then capital gain, then the gains will be subject to tax. What this means is that if, for instance, there is a disposal of shares and the value, even though the threshold for exemption is 150 million, and the proceeds from the disposal is, say, about 120 million, which is less than the 150. But if the gain from that disposal is above 10 million, that exemption based on the threshold of 150 million will not apply. That is the implication of this. So these two conditions must be fulfilled for such a gain to be exempted from tax, which means the proceed must be less than 150 and the gain must be less than 10 million within 12 calendar months. So this is not looking at a single disposal. You are looking at in a period of 12 months, if the total disposal within a period of 12 months is within 115 million, that will be exempted. If the profit also from the disposal within 12 months is not more than 10 million, then such a person will enjoy exemption. And there is another thing that has also been introduced, which has to do with a debt forgiveness. Currently, we don't have any provision in all the tax laws that deal with a situation where somebody is forgiven a debt is owing. But the new bill has now introduced a new provision that will recognize such situation where some individual or company is forgiven their debt. The debt, the value of that debt will be taken as chargeable gains and be taxed either as company income tax or as personal income tax, depending on who is involved. Right? We also have compensation for loss of office. Currently, any excess of 10 million paid to an individual as compensation for loss of office is currently taxable at 10% under the Capital Gains Tax Act. Under the new bill, the threshold has now been increased to 50 million, which means any compensation received by an individual for loss of office, if it's below 15 million, it will not be taxed. But once it's above 50 million, the excess above that 50 million will be taxed as normal income using the personal income tax rate to tax that. And the filing of returns, before now, there is need to, or currently there is need to file capital gains tax returns separately every 6 months. But with the new proposal, if there is a disposal of a chargeable asset and there is gain, that will be disclosed together with your normal income as a company or as individual. When you are filing your personal income tax returns, you must include that as your income and tax it accordingly. So quickly, that is what we have on the capital gains tax. I will also talk about the company's income tax. There are changes that has to do with the company's taxation of companies. And some of the changes, again, of course, we all know that Nigerian companies are liable to tax in Nigeria on their global income. That will continue to apply. I've mentioned earlier that loss-making companies are now exempted from paying tax if in any year of assessment a company makes loss. There will be no minimum tax applicable. However, there is a new introduction of minimum tax, but this minimum tax is not applicable to all companies. This is applicable to only multinationals and large companies, Nigerian companies with turnover of above 20 billion naira. What the drafters of the bills have considered here is the OECD Pillar 2. That is what is called Pillar 1, Pillar 2 under the OECD. Some years now, there's been conversation around a global minimum tax of 15% for multinationals, which means every company is expected to pay at least 15% effective tax rate every year. So when you look at the tax paid every year compared to your revenue and do the calculation, it should be up to 15%. So that is what has been introduced in Nigeria also, to say that multinationals and large companies must at least pay up to 15% effective tax rate. However, how to compute this effective tax rate of 15% has not been issued because it's not included in the bill. FRS is given the power and discretion to determine how that will be computed. But going by what the OECD has recommended, in computing the effective tax rate, is supposed to be the tax paid by the company divided by adjusted profit. And that adjusted profit will be after making some adjustment to the net profit before tax to arrive at that adjusted profit. So it's a bit complex computation that you need to do all that to arrive at the effective tax rate. And where is discovered that the companies in this category that they have paid tax that is less than 15% of their effective tax rate, they'll be required to pay additional tax in that particular year of assessment. So that is a new introduction that is coming. And any expenses on which VAT is due but is not charged, including assets, the bill has proposed that if you incur an expense and there is no VAT on it, such expense will not qualify for deduction as an expense, which means every company now needs to ensure that VAT is paid on all their expenses, including their assets, because that has also been included in the bill as a condition for claiming capital allowance. And I mentioned earlier, companies' income tax rate is expected to reduce from the current 30% we have to 25% in the next 2 years, right? And we have a new levy that has been introduced, which is 4% of accessible profit. The new levy, which is the development levy, is expected to replace education tax, NITDA, which is the information technology development levy, and NASENI levy, police levy. We currently have all these levies computed at different stage. So when FRS comes and they are doing audits, they start to ask questions on each of these levy, and the agencies can also query the country to say, come and make returns and others. So all these have been collapsed to one single levy, which is development levy. Currently, 4% has been proposed, but this is expected to reduce to 2% by 2030. Okay. So the other thing is a threshold for small companies. I've mentioned this, that is now increased from 25 million to 50 million, or using the asset base of the company, the companies with the assets of 250 million and below. Withholding tax, dividend distributed by small companies are currently not subject to withholding tax. But under the bill, there is a proposal to tax dividend distribution by these small companies. And capital allowance has also, the rule for claiming capital allowance is also going to change. Currently, in claiming your capital allowance, you have the initial allowance, the annual allowance, and when there is disposal of asset, there will be a balancing charge or balancing allowance. So all these have been amended. Going forward, companies will only be able to claim annual allowance, no more initial allowance or balancing allowance when asset is disposed. At the end of the day, taxpayers will still claim their capital allowance 100%. The only difference we are going to have now is that currently in the first year that a company incurred qualifying capital expenditure, you are allowed to claim more in that first year as capital allowance. But going forward, we are going to then spread the capital allowance over a period of either 4 years or 5 years, and for some assets, 10 years, depending on the class of assets. So we have a new categorization of assets now in the tax bill. So, and when the asset is disposed, there is no need to then start doing all those balancing charge, balancing allowance anymore. You then need to take the sales proceeds from that disposal, then less the book value of the assets, and not the cost again in determining whether there is gain or not. So for an asset that has been used by a business, the basis of determining the gains on that asset is different from how to determine the gain for an investment property. For investment property, you still look at the sales proceed and the cost. But for an asset that is used for business purpose, you will look at the sales proceed and the book value of the asset. Whatever that is the difference, will go straight to your income tax and will be taxed. I've talked about other levies and all that. So those are basically the changes that are expected, major changes for income tax. And again, we have this restriction on related party, interest on related party loan, which was introduced in 2019 Finance Act. And that provision provides that where a Nigerian company has a loan and they are paying interest, especially they are paying interest to a non-resident related entity, there is a restriction in the 7th schedule that limits the total interest expense that such company can claim as deduction. The provision restricts or limits the interest claimable to 30% of the EBITDA of the company, which is earning before interest, tax, depreciation, and amortization. And this is applicable, this will not be applicable on the total interest expense of the company, including interest payable to non-related parties, right? So, which is what we currently have. But the new proposal now has changed that provision that will make that restriction to apply only to related party loans, which means the company, a Nigerian company with a foreign related party loan, this rule will only apply to the interest payable to the related party, and all other interests that are payable to unrelated lenders will be available for full deduction, right? So this is a new rule that are currently proposed in the tax bill, which is a great improvement over what we have under the 7th schedule. So that's just the few highlights of what we have in terms of taxation of companies. The next thing we quickly look at is the economic development tax incentive. Currently, we have a law which is the Income Tax Industrial Development Tax Relief Act, which deals with pioneer incentives. And pioneer incentive is a tax holiday given to companies for engaging in a particular line of business, right? We have that pioneer incentive, which is a tax holiday, and is currently available for a period of 5 years. So that law will be repealed. We now have what is known as economic development tax incentive. That is what the bill has proposed. And under the bill, what we have currently as a pioneer product has now been renamed as priority sectors. So in the bill, we have priority sectors, which are mainly manufacturing industries that or businesses that have been provided for in the bill. They are the ones that will now be enjoying this incentive, right? And some of the highlights of this incentive, again, is under the current regime. There is no tax on dividend distributed by these companies in this sector. Any company that is under pioneer incentive, profit derived by such company during the pioneer period, which is tax holiday period, will be distributed without any form of tax on the dividend. That provision has now been removed. So when a company in this priority sector, if they make profit, if they are distributing the dividend, withholding tax will apply. And there is also increase in the threshold for investment to qualify for this incentive, which has now increased from 30 million up to 200 billion, depending on the industry or the project that the taxpayer want to embark upon. So looking at the changes now, under the new regime that is proposed, the incentive is going to last for about 10, between 5, it can be enjoyed up to 10 years. And the law has also, the new bill has also introduced what is known as sunset period, which means this is now going to be different from what we have currently. What we have currently, there is no period in the current legislation on a pioneer incentive that talks about for a particular line of business or product, this incentive will only last for a period of 10 years or for 20 years. We currently do not have that. But in the new tax bill, we now have what they call sunset period, which means for every priority sector that have been provided for in the bill, there is a period upon which that incentive will last. And we have it between 10 years and 20 years, depending on the industry. So after 20 years, it's expected that all these incentives will not be available to anybody again, except if there is a review of this law by that time to continue to enjoy that. Another major changes that we also have regarding this tax holiday period or pioneer incentive is under the current legislation, companies during tax holiday, they are allowed to defer their capital allowances, which means during the tax holiday, they don't compute any capital allowance. That incentive is now being removed under the new tax bill. The new tax bill has now made provision that during your tax holiday period, compute your tax like every other company, claim your capital allowance and compute the tax payable, file your tax returns. Under the current legislation, they are exempted from all taxes. But in the proposed legislation, they're expected to compute their taxes, file their returns, but such company that is enjoying the holiday will be issued a tax credit that they will now use to settle their tax liability. And the essence of doing this is to ensure that there is data available such that at the end of every year, government wants to say that this is the total incentive that they gave a particular company, a particular industry, because data is very, very important for national development. Currently, government has been struggling with getting that information because most of these companies that are currently enjoying this incentive, they don't compute tax. Some of them don't even file the returns, but now it is compulsory. You must file your returns. You must compute your tax, and government will give tax credit that they will use to pay the tax, right? So that government can track what is happening in that industry. So those are the major highlights regarding grant of tax incentives as proposed in the new bill. And the major one, which is the value-added tax, this has been generating a lot of argument and controversy everywhere. One is the rate is going to increase. Currently, is 7.5. There is proposal to increase it to 10% next year between January and December 2025. And from January, 1st January 2026 to 31st December 2029, the rate will move from 10% to 12.5. And from 1st January 2030, the rate will move to 15%. So the idea is to increase the VAT rate from the current 7.5 to 15% in the next 5 years, right? And of course, we still talk about the impact of that on businesses and the individual. And the new bill has also introduced electronic invoicing and fiscalization, which means government will be introducing, will be deploying technology for the purpose of VAT collection. Businesses is going to now be plugged into government devices or platform that are provided by government, so that as you are doing your business, as you are selling, as you are providing service, you are invoicing, the VAT due on it will be deducted immediately and go to government instantly. That is what they are proposing. So how that is going to be done is left for government to determine if the law is passed. But there is introduction of electronic invoicing, that every business must invoice electronically, and this will now synchronize with a government database, so that they have that information at every point in time. And businesses are now allowed to recover the input VAT they incur on all their business expense. They are allowed to recover it 100%. Currently, businesses are not allowed to recover full input VAT. Businesses are only allowed to recover VAT on raw materials or goods purchased for resale. But what is proposed in the bill is that VAT is meant to be borne by the final consumer of goods and services. Now, a company that is producing goods, they are not the consumer of such. So every expenses or cost they incur up to the point of selling that product to a wholesaler or to a retailer, they are expected to claim that VAT at that point. And that is how it will continue to go until it gets to the final consumer. And this is going to have impact on what the impact of VAT should ordinarily be, because a lot of people have been worried that, oh, with the increase in the rate of VAT, which means businesses will increase the prices of goods, they are going to charge it back and all that. But with what is being proposed here, it's unlikely that even with the increase, it's unlikely that it's going to impact on the prices of goods, because for companies that have not been claiming all their input VAT, they are now expected to claim, which means there is going to be drop in what used to be their cost. For instance, all the costs that the company currently incurring, there is an additional 7.5 VAT that they are recognizing, which they add to that cost because they are not allowed to claim it as input VAT. But with this proposal, they will no longer add the VAT expense as part of their business expense. So that is expected that the cost of production is supposed to reduce, including the VAT on their assets. They are supposed to claim it as a input VAT going forward. Now, of course, I've mentioned issue of deployment of technology, and a lot of goods and services that they've now been classified as a zero rated, which means the VAT on them will be at 0% going forward. And this is mainly on essential commodities or items that are used by almost everybody across the different levels in the society. So it's expected that many items will be exempted from VAT, just to bring down the burden of the increase in the rate of the VAT. Now let's look at this. The Presidential Committee did a survey in the course of their work, and they came up with some figures to say, for every household in Nigeria, that this is how they spend their income, right? And in doing that, they've been able to come up with figures to say that 52% of income goes to food and beverages, and you have another 17% on housing, water, electricity, gas, and other fares. You have transportation, you have clothing, you have furniture. So this is how they have categorized as spending for every individual, that this is how an average household spend their income. And what they have now recommended is to say that if this is how income is being spent, now the VAT rate is going to be increased. And VAT is currently applicable on almost all these items across the different levels, right? So what they have now done is to say that about 82% of what we have on this table that average household spend their income on, that about 82% of them will be exempted from VAT. And how did they arrive at that? They are saying that the 52%, all the items that are classified as food and non-alcoholic beverages, which has to do with basic food, anything classified as basic food, they are going to be zero rated, which means there will be no VAT on all of them. That is 52%. And everything also classified as housing, water, electricity, gas, and all that. There is also a proposal that the 17% will also be removed. Transportation is also going to be removed. There is no VAT. And there is also not going to be VAT on education and health. So by the time you add all those lines, it will give you about 82%. So the proposal, what we have in the bill, is that 82% of what we currently spend our incomes on will be exempted from VAT, which means, yes, there is increase in the VAT rate, but there is likelihood that the VAT burden for everybody will reduce. So that is the essence of this analysis that they have done here. And of course, I've mentioned that there is expansion. All the items that are now zero rated or exempted from VAT, all basic foods, medical, education, and all that. So all these items have now been exempted from VAT, including locally produced agric products and seeds and all that. Electricity generation is also exempted from VAT, and the transmission, medical services, tuition, exported goods, including excluding oil and gas, exported services, exported corporate properties, like a Nigerian resident, for instance, has a right over an asset, and you decide to give it out to other people for exploitation and for use, such will not attract VAT, any form of export. So those are the things that have been classified as items that will no longer attract VAT, which effectively means that VAT burden is supposed to reduce. So those are the things that, or the changes we expect regarding VAT, all things being equal. And other changes that has been proposed in the national Nigerian tax bill as well is we have a simplified stamp duties regime now, which has now modified the current stamp duty act we have. I mentioned earlier that the current stamp duty is a 1939 act, which when you look at the law, the way it's drafted, most of the things we have in the law is no more in terms with the current realities. So the law is going to be repealed. So we have a more simplified and organized stamp duty act that has now clearly listed all the items that are liable to stamp duty and the applicable rates. So we have all that now in the new bill. And we also have another levy that has been proposed in the bill, which is the excise tax of 5%. And this is going to apply on telecom services and the lottery. So there is a proposal to charge 5% excise tax. And the whole idea of this is to saying that looking at states and local government, that there are currently about 40 different taxes and levies that are being collected at different states and local government level. So there is a proposal to eliminate all those levies. And you must offer something to be able to eliminate that. So the committee has now recommended that let's have what is known as this excise tax of 5% of telecoms to replace that over 40% levies. Because at times you travel to some states and on your way going, you just see some people will come out and block the road and ask you to obtain one ticket. You move to another local government, you see another roadblock and all that. So they are trying to eliminate all that. And that is what this 5% is being proposed for, that this will replace all that levies. Though this was initially introduced 2019, but later suspended. But the new bill has now introduced that again. And another thing that is important for us to note again is it's expected that there will be more coordination between the revenue services. That's both the federal and the state revenue services. There's going to be more coordination as a result of the Nigeria Revenue Service Bill, and as well as the Joint Revenue Board Bill. So it's expected that they will work together. They are going to work in collaboration, which means exchange of information. In the course of FIRS doing audit of a company now, for instance, if they obtain information that has to do with taxation of individual, they will be able to share that same information with the state internal revenue service, because all these revenue services, both the state and federal, they're expected to be under a single umbrella going forward. So exchange of information will be made easier, which means for a company, you may not be able to hide information relating to your employees going forward, because you want to claim deduction for it. So you definitely want to present it to FIRS when they are auditing you. And FIRS can as well pass that information to the state internal revenue service. And there is also a proposal in the bill that now require that taxpayers must pay their undisputed tax liabilities whenever there is dispute with tax official. Currently, if there is an assessment from a tax authority and the taxpayer feel like, no, this is too much, you will object. And that will continue to drag and drag. It may be on like that for the next 1 year, 2 years without resolving. And it's until when it's resolved before you pay. But the new bill proposed that when there is dispute between the tax administrator and the taxpayer must pay the portion of the tax that they agree that they are owing while resolving the dispute. So if tax authority gives you a liability and assessment for 1 million, and you are saying that what you are owing is just 100,000, the expectation is that at the point of making that objection of saying you are not owing that 1 million, you are expected to pay the 100,000 you agree that you are owing. I've mentioned this earlier that there is now establishment of the Office of the Tax Ombudsman. This office is going to act as a mediator between tax authority and the taxpayer. If a taxpayer has issue with tax authority, maybe regarding assessment or whatever, the first point of call should be the tax ombudsman before any further step. So you call the tax ombudsman that, oh, this is the challenge you are having with Nigerian Revenue Service or State Revenue Service. After lodging that complaint, the tax ombudsman is expected to engage the relevant tax authority in resolving the dispute. It's only when the dispute cannot be resolved at that level that you can then go to the tax appeal tribunal to further resolution. So that is also a new initiative that is being introduced in the tax bill. And of course, all these new proposals in the law with the existing ones that will still be retained, there is now a heavy penalty for non-compliance, which means taxpayers are expected either to comply or to pay penalty. So there is now a heavy penalty for any form of non-compliance, including imprisonment. There is a lot of them, and start from some penalty that are currently, you have 5,000, for instance, for non-filing of returns and all that. So all that have now changed. And another thing is that the penalties have now been harmonized. What we have currently is that in the VAT Act, you have a different penalty that is applicable. When you go to the Companies Income Tax Act, there is a different penalty. When you go to Petroleum Profit Tax Act, there is a different penalty regime. But what this bill now seeks to do is there is now a unified penalty that will apply across different for different offenses. So whether the offense relate to VAT, or it relate to company income tax, or it relate to stamp duty, the penalty that is applicable is the same. So that is what we have here, and we have a whole lot of them, starting from a failure to register for tax, award of contracts. Now, this award of contract now is as a company. If you want to give any contract to any individual, you must ask for the tax identification number of that individual or company. It's now a condition for awarding contract. And if the person, the contractor, does not present a tax identification number, and the company goes ahead to award the contract, there is a penalty of 5 million naira for doing that. And there's penalty of failure to file returns, starting from 100,000 in the first month up to 50,000 every subsequent month. Failure to keep books, failure to grant asset to grant asset for technology development. I've mentioned this, that for the purpose of VAT compliance, the expectation is that government is going to be deploying technology in business premises to say that, okay, let's see the system you are using for your business. They are going to be either installing a software or plugging something there that will now make collection of VAT, for instance, to be done instantly. And if a taxpayer, for instance, refuses to grant asset to that government agency that will come and install that technology or deploy it in your business premises, there is now a penalty of 1,010,000 naira every day. And failure for fiscalization, where you refuse to use technology to collect VAT in the manner that is expected, which means the VAT must be at a point of sales immediately. You must account for it. There is also a penalty for that. And failure to deduct tax, there is penalty of 40% of the amount not to deduct. Failure to make attribution. The issue of attribution has been generating a lot of controversies, which means as a company, if you have businesses across the different 36 states of the federation, you are supposed, when you are filing your VAT returns, to be able to say this is the amount from each state. You are supposed to differentiate that, which is different from what we currently practice, where every business is file their VAT centrally at a single point, but you are supposed to make additional disclosure going forward. And there is also failure to remit tax deducted at source and all that. So we have all these penalties now. So we have so many of them that have been introduced, including imprisonment of up to 5 years, depending on the offense. So, which means compliance is now very, very critical. It's important that everybody now plan how to comply with these different provisions in the tax law. And in conclusion, the new tax law, if passed, is expected to become effective from 2025. And the Fiscal Policy Reform Committee have also hinted that whenever the law is passed, there is an expectation that they are going to give at least 90 days transition period for every company or individual before the implementation will start. And the enactment of this new law is expected to streamline the number of taxes and also reduce the burden of a tax compliance. Introduction of technology and fiscalization is expected to increase government revenue if properly deployed. And more people are likely going to come into the tax net. With the way the new bill has been done and all the proposals there, it's expected that many people that are currently not in the tax net will come, because there is a proposal that they are going to be using everybody's either NIN or BVN as the primary tax unique ID, which means once you have a BVN, that is already a tax ID for you, and everything you want to do will be linked to either the BVN or NIN. So more people are expected to come in. And of course, for personal income tax, some category of individual, their income, their tax will reduce. Why for some set of individual, their tax will definitely go up, depending on the income level. And from that analysis that I show you, that everybody earning below 30 million, their tax is expected to reduce. And for everybody earning above that, we have their tax increase depending on the income. And the introduction of the minimum tax rate of 15% of ETR is also going to happen, and this will affect big company majorly. And VAT burden is expected to reduce. And then lastly, I mentioned last that penalty, there is now a stiffer penalty for non-compliance with all these provisions. So it is important that even while the National Assembly is still working on the bills, we start planning our affairs on how we are going to comply and how we are going to structure our businesses to make sure that we don't run foul of any of the provision. So thank you. That is end of my presentation so that I
Thank
don't
you.
take too much time. Yeah, thank
Thank
you.
you very much, sir. Thank you, Mr. Fidelis. I mean, you've done justice to this presentation by breaking it down. And we've seen some key highlights of the new tax reform, which is harmonization of tax laws, increase in VAT, then the reduction of tax for small businesses. Before we conclude, we have some questions. Idongesit Uruk is asking you that your presentation appears to suggest that new tax reform aims to reduce taxable income for low-income earners, while it's increased for high-income earners. However, it seems to imply that the government might consider taxing income that is currently deducted from statutory employee compensation, such as the group life, NSITF. Could you kindly clarify this point, sir? So quickly, sir, if you can clarify for us.
Okay, thank you. Yeah, I mentioned during the presentation that some of the deductions we currently have in form of reliefs for individuals, we have pension, we have life insurance, we have the health insurance scheme and all that. All those are still available as deduction. So the the new bill will not remove that. We still continue to enjoy that as a relief. And if you also receive a pension, maybe upon retirement and all that, it's still exempted from tax 100%. So it's not going to work that way. So not that government will, because they want to increase revenue as a result of the level of taxpayers, that their tax will reduce, and then incomes that are now currently exempted will now become taxable. No, that's not how it's going to work. Incomes that are currently exempted will continue to enjoy that exemption for individuals.
Thank you very much, sir, for your question, for your answer. My question is on small businesses now. I mean, we've seen that the new reform bill is going to exempt them from paying income tax. But how does this affect the government revenue, like Nigeria's revenue as a whole? I would have thought the increase in VAT will compensate for it, but VAT is 82%, as you said in your presentation, is going to be exempted. So how is it that government wants to do with this revenue? Are they going, is there some kind of trade-off somewhere that we don't know yet?
All right. So before now, the issue of small businesses uh, has been there before now. And in fact, since 2019, small businesses uh, are exempted from tax, right? And before taking that decision, there's been some form of analysis by government to look at, okay, currently analyzing the taxpayers. And they have seen that these small businesses we are talking about, as in people with turnover of less than 25 million, they contribute less than 1% to the tax revenue of government. And then cost of compliance, you tend to spend more in terms of compliance, as in the administrative cost now from the government. An entity or a set of taxpayers that are contributing less than 1%, but you end up spending times 10 of what they are contributing to the pool in ensuring their compliance, right? So removing them from tax net or from payment of tax will not in any way affect government revenue, because they have done that analysis and see that their contribution is very, very insignificant. And if they stop paying or they remove them, now that cost of ensuring their compliance that government was initially incurring, they will be able to save that instead. So it's really not going to change anything. And the idea again is to also align this business to ensure that small businesses are growing, because that is where you have the larger population. You have a whole lot of people operating in that space. And there's been research that has been done by World Bank to show that most developed economies, you have a whole large percentage of their populace playing in that small and medium scale sector. So they want to encourage people in that industry. So it's not going to affect government revenue per se.
Okay, thank you very much for that answer. What are the key challenges the government may face in implementing this new bill if this House of Assembly signs it into law? Are there some challenges they're going to face?
Yeah, definitely every law, policies of government comes with its own challenges. Already we are having a pushback from a part of the country saying they don't want the bill, especially regarding the issue of attribution, right? To say that the VAT revenue will be shared based on derivation and other. So we already have that challenge there. And of course, there is also going to be challenge regarding this issue of deployment of technology. How do you manage that? Do we really have infrastructure to support that? You are deploying technology in a business that there will be no light to even power the infrastructure that you are going to use for that technology. So that those challenges are there. And There is also issue of data security. If government is coming to plug in its own system to your system as a business, how are you sure that your information is safe? How are you sure that the information that they are generating from that their own device or platform, how are you sure that that information is not going to a third party that may use it against you, or may say, oh, so this person, he has so much money or is making this whole lot of money with kidnapping being a lucrative business now. So issue of data security is also a major concern, right? And we also have all these other revenue from local government that government is saying they want to scrap all of them, because most times when you go on the road, you see people blocking road, running after you. Oh, you need to get this ticket, you need to pay this level. And now government is saying they want to stop everything. Definitely, it's not going to be easy to stop it. It's going to really be a major challenge. You don't expect those people that are benefiting from that to easily give up, right? But the committee that make all these proposals, they also make recommendation on how to make sure that those challenges are also managed. For instance, the issues around deployment of technology, there is proposal to say that before government can deploy that technology, there is a minimum standard that must be in place, just like what we have currently on common reporting standard in Nigeria, which is being done in Nigeria. There is a minimum standard that OECD gave Nigeria, that you must meet this minimum requirement before you can participate. And government was able to meet all that infrastructure requirement. They have it in place. So they are also saying that before you can deploy technology, you must have all that in place to ensure that data is secure. So challenges are there really in terms of technology, in terms of attribution, sharing of the revenue, and even the harmonization of the tax itself. Those challenges are definitely there, but I believe government are also mapping out strategies on how to manage all those challenges.
Thank you very much, sir, for your answers. Ladies and gentlemen, it's time we wrap up today's session. I want to extend my gratitude to everyone that joined us today for this edition. A special thank you to our esteemed speaker, Mr. Fidelis Chukwu, FCA, for his insightful and thorough analysis of the new tax reform bill. Thank you very much, sir. We really appreciate you. To our participants, thank you for your engagement, your questions, and we encourage you to stay connected with us at Utica Capital Limited for more insightful discussions like this. Thank you once again, everyone, and we look forward to you joining us for future editions of Utica Discourse. Bye.